call the new projects. So for WSCC is when evaluating the existing what? Projects. Kumaanisha hiyo information number 1 in my case it is not of any use, the first paragraph. What will be now of use is from the second paragraph, which is the capital structure, meaning that is the existing capital structure of the company. And that is now what I'll be able to base on. So now, the one on Roman number 1, the cost of ordinary shares. Cost of ordinary shares. Now, on the cost of ordinary shares, this is our KE. And now that here we were given the expected dividend. Remember, in our case, we always say is DO. 1 plus G. All over PO minus rotation cost, you add G times 100. So I also said, oh, you get this if you are given the next dividend, which is given by DO1 plus G, D1, just divide by PO minus flotation cost G, multiply by 100. So in our case, what we were given is this next dividend. Always, when determining either the value or the cost, I said we always use what we call the next word or the expected dividend. And our expected dividend on number 1, which is now the expected ordinary share dividend next year, we were given 2 point what? It was 2.4. You will divide by the market price is 60. No flotation cost, will just add the growth rate, which was 10%. And then I can multiply by 100. This will give you how much? How much is it giving you? It is giving you how much? 2.4 over 60. You add 0.1 times 100. How much is it giving you? 14%. So that is 14%. Go to Roman number 2. Roman number 2, we have the cost of long-term debentures. Now, long-term debentures here, we said when you get the debentures, you have first to identify whether they are redeemable or what we call the irredeemable debenture. Are we together? And therefore, this is it. When you look at our case here, we've been given that the debenture will have a maturity of 100 years. Meaning that here, what we're looking for is what we call the cost of redeemable debenture, which is also what we call the yield to what? Maturity. And how do we get the yield to maturity? It will be interest. You add the maturity value, which is the VAR value. I minus the value of debenture, 1 over maturity period. You divide by the maturity value plus value of debenture 1 over 2. And all these 1 minus the taxation. And then you multiply by 100. So our interest, this is per debenture, per value, which in this case, the interest rate was 6. Per value of the debenture, you get it on the capital structure, which was 100 and what? 150. How much is it giving you? Inakupea ngapi? given you. Getting how much? This is the 9%. The maturity value is just the VAR value. So maturity value will be this VAR value, 150. Value of the debenture is the market value of the debenture, which we have it on additional information number 3, 100. Maturity period is also 100 years. And then the tax rate we were given 30%. So our KD will be given by the interest, which is 9. Maturity value 150 minus 100. Multiply by 1/100. Then you divide by 150 plus 100. 1/2. Then you multiply by 1 minus the tax rate. And all these we multiply by 100. Multiply by 100. So I'll begin with 150, I minus 100. Then I multiply by 1/100. You add 9. Then divide by. This is 250 divided by 2. Then you multiply by 0.7 times 100. This is 5.32%. 5.32%. That is what will be the cost of ordinary shares. We continue. We also have what we call the cost of 10%. The cost of 10%. This is preference shares. For preference shares, which is the KP, should be given by D all over PO minus flotation cost times 100. This is the dividend per share, which in this case you base it on the capital structure. This was should be 10% of 20. 10% of 20, this is 2. Then we have the market price of the debenture. On additional of the preference shares, on additional information number 4, preference shares were issued 4 years ago and are still trading at face value. When we talk of face value, it's just the VAR value. And the VAR value here is still the 20. Therefore, this will be 2 all over 20 and 0 times 100. It will still be 10%. That is the cost of preference shares. Anything that is still trading at VAR value, in that case, it will be equals to that. So from there, we can now get the WSCC. WSCC, the weighted average cost of capital, should be given by weight of ordinary shares, cost of ordinary shares, weight of preference shares, cost of preference shares, weight of debenture, cost of debenture. That is how we get the WSCC. We don't have the weight here. We are required to use what we call the market value. So I will look for the total market value. The total market value. So we begin with the ordinary shares. The ordinary shares there, you just check the number of shares, which already we were given 3 million. You multiply by the market price. Market price of ordinary shares was 60, and therefore this will be equivalent to 180 million. You also have for the preference shares. Preference shares, the number of shares, they were 1 million. They are trading at VAR value, so it is still 20. This will be 20 million. And the last one is now for the debentures. Debentures, you need to know the number of debentures, which already we were given, they were 200,000, 0.2 million. You multiply by 100. This will be 20 million. Therefore, with that now, you get the total market value. Total market value, this will be 220. Therefore, now we can get the WSCC, which will be the ordinary share capital, the 180 million. You divide by 220 times 220, you multiply by the cost of ordinary shares, 14, 20 all over. This is 220. Cost of preference shares, we got in 10, then 20 all over 220. Multiply by 5.32. What will be our WSCC? What will be our WSCC? And over 220 multiplied by 5.32. This is 12.85%. That is 12.85%. Here, as I've said, we are looking for the WSCC, which is the overall cost of existing funds of a company. And I said for WSCC, we use it when evaluating the existing project. For WMCC, which is the weighted marginal cost of capital, it is the overall cost of new funds to be raised. And therefore, we use it when evaluating new projects. So that is on that part of the WSCC. The WSCC. We continue. We can do on now the WMCC, the weighted marginal cost of capital. 0.2 is the 200,000 on debenture. 200,000, if I make it in million, it will be 0.2 million. The 0.2 million. Either you use them without the percentage, you will also be required after you get the answer, you multiply by 100. So just use it as it is, 10, because at the end of it, you will also need it as a percentage. Need it as a percentage. When I talk of WSCC or WMCC, it is a required rate of return. Therefore, if it's a return, it has to be a percentage. It has to be a percentage. Hoping that that is okay. So we can do on WMCC, the weighted marginal cost of capital. Weighted marginal cost of capital. Financial decision making. On finance or decision making. April 2024, we do question 1C. Finance for decision making. April 2024, 1C. April 2024, question 1C. And those that are doing financial decision making, the higher chance is on WMCC. In fact, even when you look at the paper, it can tell you. In April 2024, it was WMCC. If you look at the other one, it was on WSEC. But now that they have the last time they had us on the WMCC was that you are expecting on that. So FDM April 2024 question number 1C. 1C. Luna Limited is contemplating raising an additional shillings 5 million to finance an expansion program. Then, we being given that the firm's capital structure, which is considered optimal, is given as follows. You have the ordinary share capital, the reserves, 12% debenture capital, and we have the 14% preference share capital. Being given that the new ordinary shares will be issued at 70, each to a flotation cost of 10% of the issue price. We've also been given that the firm dividend policy is that future dividends are expected to grow at 8% per each year in perpetuity. Firm paid dividend of shillings 4 per share. In the current year, new 12% irredeemable debenture will be issued at 120 each. Rotation cost of 10 is incurred or will be incurred. New 14% preference shares will be issued at 30. Rotation cost of 30, this is of 3 per share will be incurred. Corporation tax rate is 30%. You are required. But one is the cost of retained earnings. Cost of retained earnings, the KR. So to get the KR here will be given by the DO 1 plus D all over PO plus G multiplied by the flotation cost. DO is the last dividend paid, and we were given that on additional information number 404. 1 plus the growth rate of 8%. 8% is 0.08. Divided by the market value of the ordinary share is 70 plus 0.08. Then you multiply by 100. This will be 4, you multiply by 1.08 divided by 70 plus 0.08 times 100. This is 14.17. That one is the cost of ordinary shares. Roman number 2, cost of ordinary shares. Now, on the cost of ordinary shares, which is the KE, to be the DO, 1 plus G over PO. Here we allow up to incorporate the flotation cost. You have the growth rate multiplied by 100. So flotation cost from additional information number 1 was 10% of the issue price. So 10% of 70, which should be 7. Therefore, the only difference here is that I will let the flotation cost. So 70, I'll minus 77, 0.08. Then you multiply by 100. So this will be equal to how much? 4 you multiply by 1.08 divided by 63, 0.08. This is 14.86%. Go to Roman number 3. Number 3 is the cost of debenture. 12% debenture capital. Debenture capital. Now for the debenture, this was an irredeemable debenture. And how do we get the cost of irredeemable debenture? The cost of irredeemable debenture should be given by interest. 1 minus the taxation you divide by the value of debenture minus rotation cost you multiply by 100. Interest per debenture should be given by how much? Interest per debenture, you just go to the value or the capital structure, which is a total percent of the value. This is total. Value of debenture, we have it on additional information number 2. Currently trading at 120, rotation cost of 10. So this will be given by 12. 1 minus the taxation. You divide by the value of debenture 120 minus 10, then you multiply by 100. So 12 you multiply by 0.7 plus 110. Then you multiply by 100. 7.64%. 64%. Roman number 4. Roman number 4, they want the cost of 14%. 14. Preference share capital or the preference shares. For preference shares here, to be given by the KP should be D, all over PO minus rotation cost times 100. D is the dividend per share from the capital structure. It was 14% of 25. This will be how much? 0.14 times 25, 3.5. They are currently trading at how much? They are currently trading at, when you look at the additional information number 3, 30, that is 30, flotation cost of 3. That is for that one, so it will be given by how much? This will be 3.5 all over 30 minus 3 times 100. So this will be 3.5 divided by 27, the 100, 12.96%. Last one, they want we get the WMCC, the WMCC, which is now the weighted marginal cost of capital, WMCC. This will be given by weight of retained earning, cost of retained earning, weight of ordinary shares, cost of ordinary shares, weight of preference shares, cost of preference shares, and weight of debenture, cost of debenture. What we include here is only the cost of retained earning. Since here we consider, when we're looking for the weights, we consider the total amount to raise. Amount to raise. And this amount will be raised through the retained earnings. Retained earnings. We also have the ordinary shares. The ordinary shares. We also have through preference shares. And the last one is through the debentures. How much does he want to raise? He wants to raise how much? Well, given the amount to raise is 5 what? This is 5 million, which should be our total. So now that we've not been given the amount to be raised through the retained earning, I will just go to the existing capital structure. We have the reserve. Reserves was 6 million, you divide by 36 million. You multiply by the total amount to raise. Same case for the ordinary shares, you will take the 10 million, divide by 36. You also multiply by 5 million. And that one will be for the debenture. Preference shares will be 12 out of 36 million, multiply by 5 million. This one for the debenture will also be 8 million, divided by 36 million. This is out of the existing capital structure. That is, we'll just get the proportion of existing capital structure, which will help us in determining the amount to raise for each. So 6 you divide by 36, you multiply by 5. This will be 0.83 million. That one is 10 over 36, multiply by 5. This is 1.39 million. That one is 12 over 36, you multiply by that. This is 1.67 million. The last one is 8 over 36. This is 1.1 million. Therefore, with that, we can get the WMCC. Weight of retained earnings 0.83 million. I divide by 5 million, cost of retained earning. It was 14.17. 1.39 million. Divide by 5 million, you multiply by the cost of ordinary shares, 14.86, plus 1.67 million, divide by 5 million, you multiply by the cost of preference shares, which was 12.96. The last one, 1.11 million, divide by 5 million, you multiply by the cost of the debenture, which is 7.64. Here it will give you how much? $12.51%. That is the WMCC. We have a small break, then we come and proceed from there. I think that one is all done on cost of capital. If you want more on the same, just check on the recording. I've done so many questions on the same. I think we can now get to valuation model. Valuation model. Generally, the valuation of securities, valuation models, we do on the valuation of securities. Now, on valuation model, remember there is a valuation of bonds. There is also valuation of what we call the ordinary shares. And there is also the valuation of preference shares. So valuation models. From the financial management, financial management paper, from the financial management paper, to May 2018 to May 2018 to May 2018. No, not May 2018, September 2021, question 1C. September 2021. This is a financial management. September 2021, we do question number 1C. September 2021, question 1C. Delta Limited issued 16% corporate bond with a value of shillings 1,000. Bond will either be redeemed at 20% premium after 5 years or convertible into equity at a conversion rate of 100 per 2 ordinary share. Given that each of ordinary share is currently trading at the Securities Exchange for 50, it is expected the share price will increase at a constant rate of 5% each year. You are given the minimum required rate of return by investors is 12%. You are required the current value of the redeemable bond. This is a redeemable bond. And how do we get the value of a bond? It is given by the present value of what? Is the present value of interest you add? Present value of what? Sitaki kuuliza. Ndio. Ama mnakumbuka? Let me not ask. So that is on the how we get the value. So in this case, this is how do. We'll first get the present value of interest. And how do we get the present value of interest? You just take the interest per debenture, which is how much? It was 16% of 1,000. So this is 160. So you pay interest each year to get the present value. This will take us to what we call the annuity. How do we get the present value of an annuity? Money, niache kuuliza. Present value of an annuity. How do we get that? It should be given by the annuity. Present value interest factor of annuity, 12%. This was in 5 years. So this will just be 160. You go to the annuity table. Annuity table, I said, is the second table. Check on the 12% in year 5. 3.6048. Nakupea ngapi? 160 multiplied by 3.6048. This is 576,768. We also get the present value of maturity value. Maturity value is the value at which the bond will be redeemed at. So this one we've been told that it will be redeemed at a premium of how much? 5%. So it will be 1,000. You add the 5% premium. 5% of 1,000. This will be equals to 10 what? So this will just be given by the maturity value, present value interest on 12% in year 5. So it will be 1050. From the first table, you check 12% in year 5. 5674. Takupea ngapi? So 1050 multiplied by 0.674. This will be 597.95.77. Therefore, having that, we can get the value of the redeemable. Present value 576.768. You add 595.7. So I add 576.768. This is 1172.538. That is the value of the redeemable bond. Value of the redeemable bond. Roman number 2 is the current market value or the current value. This is of a convertible bond. On the convertible bond here, the value will still be the same. Present value of interest, you have the present value of maturity what? Maturity, ama ilikuwa 20? Oh, this was 20% premium, not 5%. So should be 20. Hapa ingekuwa total of what? Yeah, it is 20% premium. So mchunge, you may not create your own question like I'm doing. So total of 100, I multiply by 0.5674. This is 680.88. This is 680.88. So I add 576.768. This is 1257.648. So in the case of now the convertible bond, we'll begin with the present value of interest. That will not change. Present value of interest will still be the 160. You multiply by 3.6048. This was giving us 576.6768. What will change is now on the present value of maturity value. Now on this, we said we make the maturity value reflect the current market what? Market conditions. And the current market condition is that at expiration of the bond, it can be converted into ordinary what? Into ordinary shares. How many shares? We are told that for every shillings 100 can be converted to 2 ordinary shares at a price of how much? We've been given each ordinary share is currently trading at 50, and it is expected that the share price will increase at 5%. So what will be the number of shares? But before that, the current price is 50. It is expected to grow at 1 point, how much? That is the 5%. This is for 5 years, so power 5. We said we look for the future. So that once you get that, we can now multiply by the number of shares. 1,000 divided by 100 times 2. This is the number of shares. Let me not complicate. Can easy complicate. I'll multiply by the number of shares. The number of shares here, it is for every shillings 100 to utilize shillings 1,000 bar value. will be equivalent to how much? 1,000, you multiply by 2, divide by 100. This will be equivalent to 20 what? 20 shares. So this will be the maturity value here will be 51 plus 0.05 or 5, all these multiply by 20. What will be our maturity value? 1.05 power 5 multiply by 50 multiply by 20. This is 1276.28. Now we can look for the present value of the maturity value. So the present value of the maturity value here, present value of the maturity value, present value will be given by 11270 what? 6.28. I'll multiply 0.5674. 5674. 724.16. Therefore, the value will be given by 570 what? 576.768. You add 724.16. 724.16. So 576.768, 724.16, 1300.968, 1300.968. That is in the case of valuation of a bond. That is always in case of what we call the redeemable bonds, where you get the value by taking the present value of interest, you add the present value of the maturity value, present value of the maturity value. From the IFI paper, August 2024, question 1C. The introduction to finance and investment. August 2024. This should be question number 1. IFI. So for this one, this is on the valuation of ordinary shares, where you are told that Kingo Limited has followed a policy of paying out, gradually increasing dividend per share over the first 5 years, as shown below. Given the earning per share, we have the dividend per share. Company has paid the year 2023 dividend, and the shares are therefore quoted ex-dividend. Given the management is considering a change of the financing policy, whereby the greater Financing will be provided from internally generated fund. This change is expected to reduce the dividend per share to 2.5 in the year 2024. Growth rate in earning and dividend per share is also expected to increase in 14% per annum from year 2024. Companies' shareholders require a minimum required return on investment of 16%. You are required, using the dividend growth model, calculate the market price per share as of 31st December 2023, prior to the change in the new policy. Now, this is the valuation of ordinary shares and is on what we call the constant dividend growth rate, ordinary shares. So to get the value per share, we said you just get the DU, 1 plus G, all over KE minus G. Now, now that we are given the historical dividend, I said whenever you are given the historical dividend, you get the dividend growth rate, which we use what we call the compounding method. This is a compounding method, DO minus 1. That is when you are given the historical dividend payment. We have from 2019, 2020, 2021, 2022, and 2023. This will be our DO, D1, D2, D3, and I have D4. So our growth rate is simply 4, D4, all over DO minus 1. So this will be 4. What was the D4? In 2023, the dividend per share is 3.65. In 2020, it was 2.5. Minus 1. What will be our growth rate? This is 3.65 divided by 2.5. 4 nth root of answer. 4 nth root. 4 nth root of answer. Minus 1. This is 0.10. Therefore, our PO, the last dividend was 3.65. 1 plus the growth rate 0.1. Cost of capital, which is the minimum required rate of return, 0.16 divided by that. So that will be how much? This is 66.92. That is the market price. And the old policy, or using the dividend growth rate. So that now using this other one, you can get the value again, DO1 plus G, all over KE minus G. If the policy is changed, the dividend that will be paid is of 2.5. And this is expected in year 2024. So this will be D1 all over KE minus G. So it will be 2.5 you divide by, we were given that the minimum required rate of return is that the dividend growth rate is 0.14. So this will be changing to how much? 2.5. The reason that I'm saying is the next dividend, that is the dividend in the year 2024. When you look at the additional information number 2 as at the year end, the change in dividend will reduce to 2.5 in the year 2024, which is the expected dividend. And is always what we use, the expected dividend. So this is 125. 125. Roman number 3. Roman number 3, they determine the break-even growth rate in dividend per share using the market. This is the growth in market value. It will be P1 minus PO, you divide by PU times 100. So this will be this price 125 minus 66.92 divided by 66.92 times 100. Hiyo itakupea ngapi? 125 minus 6.692 divided by 66.92. So this is 86 or just 87%. That is the growth in price. The growth in price. That is the growth in price. FDM, I want to do April 2024. From FDM, April 2024. I just want to do question number 3B, Roman 2. 3B, Roman number 2. Three B, Roman 2. Financial decision making, August 2020, April 2024, 3B, Roman number 2. The Jackson Kill was offered a 10-year 6% coupon of shillings 100 per value bond. At a price of 900, you are required the rate of return on the bond. Well, how do we get the rate of return on the bond? How do I get the rate of return on that bond, Doreen? The rate of return on that bond itakuwaje? How do I get the rate of return on a bond? How do I get the rate of return on that bond? Anyone who is having an idea? Anyone who is having an idea of how we get the rate of return on that particular bond? It was a question of 4 marks. Anyone who is having the idea? But if I ask you, you can tell you how we get the yield to maturity or the KD of a redeemable bond. Ndio. Si mnaweza niambia? You can tell me how you get the yield to maturity. By the way, when we were talking about those costs, see, those are the required rate of return. Just a required return on a bond. When I talk of it as a required return, this is to the investor. To the company, it is a cost. But to the investor, is a what? Is that a return? And therefore, this is just the yield to maturity, interest. I just take the maturity value minus value of the bond. I will divide, multiply by 1 over n. Then you divide by maturity value, value of a bond, 1 over 2. 1 minus the taxation, then you multiply by 100. In that way. And you get the return. The only thing is that they didn't say the cost of what? They didn't say the cost of the debenture, and therefore this will be 6%. You have to multiply by the VAR value. This will be 60. The maturity value is the VAR value, which is 1,000. Value of debenture, it is currently trading at 900. Maturity period here is 10 years. And therefore, this will be interest 60. 1,000 you minus the 900. 1 over 10 divided by 1,000 plus 900. 1 over 2. Here there is no taxation, so I'll just multiply by 100. Whenever you're not given the taxation, don't assume a 30%. Just use it as it is. So this will be 100 you multiply by 1 over 10 plus 60. Divide by, this is 1,900 divided by 2. Then I multiply by 100. 7.367. That is the rate of return. That point. So more to that we do when we meet on Sunday. Let's meet on Sunday and do more other questions.